You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational.
Thank you for tuning in today. We got a very, very special guest lined up for you today. But before we get into that, take a moment and go ahead and like and share this on YouTube or Facebook. Subscribe if you can. And if you're watching it on or listening to it on iTunes, go ahead and leave me a 5-star review. But all of that's out of the way. Let's go ahead and get to our guest. Our guest today is Kelley. She is the founding partner of Zenith Capital Group, Apex Multifamily, and ReiMom LLC. She is a former top-ranked financial relationship manager for a private bank and began investing in real estate 20 years ago. Anna has purchased, renovated, and rented millions of dollars in real estate across numerous asset classes while working full-time and raising 4 active children. She recently retired from her corporate career after creating financial freedom through rental property investing. She has active ownership and manages a rental portfolio valued at over $60 million and has invested in over 2,000 doors as a limited partner. Anna actively seeks out the best multifamily investment opportunities for her partners and investors. She is a sought-after speaker and enjoys helping others to overcome fears, increase knowledge, and minimize risk in real estate. She is also an Amazon #1 best-selling author. Anna, thank you for coming on the show. How you doing today?
Thank you so much. I'm doing great, Willie. Thanks for having me.
Absolutely. I'm glad you was able to make it on. I'm so stoked for this episode today. Tell my listeners a little bit more about how you got into real estate.
So, the very first time I really thought about owning real estate was when I was in private banking, because I had a lot of clients that had a lot of wealth. And one of the things that one of my clients said to me one time when we were telling them about the types of returns we could get them in mutual funds, stocks, bonds, annuities, etc., they kind of laughed and said, I make much more than that in my real estate portfolio. And I didn't know anything about real estate. When you're training as a financial advisor, they really just teach you about the traditional investments, stocks, bonds, mutual funds, annuities, insurance, And so I didn't know very much, but it piqued my interest. And over the couple of years that I was there, several of my wealthy clients, both individuals and businesses, had quite a nice real estate portfolio. So I started thinking, one day when I have money, I will invest in real estate. And then, slowly over time, I tried to make wiser decisions about real estate. Like I bought a condo instead of throwing my money away at expensive apartments in Houston, Texas. And then, I bought a house in an up and coming area thinking I would make a bunch of money on appreciation. And then when I had my first child 16 years ago, we did our first flip. So I watched a lot of HGTV while I was home on maternity leave. Yeah. I was convinced that flipping was the way to financial freedom and being home with my baby. And I really didn't know very much about economic cycles and, what was to come in a crash, not too far ahead. But I knew that real estate in some way, shape, or form was a path to financial freedom and wealth. And so it kind of gave me the bug. And then 13 years ago, I moved to Pennsylvania with my husband to help start his chiropractic practice. Mm-hmm. And I was giving up a lucrative job, I thought, in Houston. They later let me work from home. But we were basically starting over. And so we sold everything we had. We came here. And rather than leasing commercial space, we decided it would be wiser to buy a space that had tenants and had some residential apartment units above it and behind it that would help kind of cover that mortgage. And so 2013 when we moved here, 2007 when we moved here 13 years ago, was really when we started getting into rental properties and understanding just the power of that passive income coming in from rentals to help cover your expenses.
Gotcha. That's very interesting that you guys thought about, instead of trying to go buy this building and make the payments off of the income you're bringing in from the practice, you say, hey, why don't we find a building that has tenants and let them pay for it for us? So essentially, that's the commercial version of house hacking.
Yes. we did that. And then a year later, we actually house hacked with our first 4-unit apartment building. So we had 2 young babies and starting a business from scratch, and, you know, an unsure job for me, which was a trial work from home basis after I left Houston. And so we bought a 4-unit, house hacked it, and basically all of our basic living expenses were covered just in case I lost my job, and then just in case it took a while for his business to flourish.
That was very smart. Very smart.
Yeah. So I'm a firm believer in house hacking for people that want to get started.
Absolutely. Absolutely. So in your bio, you said you've dealt with numerous asset classes. What assets have you dealt with so far?
Sure. So I have done some single family rentals and single family flips. We have Airbnb units. We have vacation rentals on the beach, and we have some garages and some self-storage units, in addition to multifamily, anywhere from, you know, duplexes all the way up to 250 unit apartment buildings.
Wow. So you're pretty much covering everything then.
Yes.
That's awesome. Okay. So which one are you liking the most right now? Because, you know, with the multifamily space, cap rates are compressing. So what are you looking at right now?
So this might be a little surprising given that this is a multifamily show, and multifamily is really where I spend most of my time. But as a former private banker, financial relationship manager, I very much think of investing not just as a business for today, but as a long-term wealth building thing to do. It's a wealth building activity. And so at different phases of our lives, different types of investments become more important. When we're younger, we can take a little more risk, and usually we're trying to build additional income streams. As we go, we're trying to build some appreciation and have our assets grow in value. And as we get a little bit older, we really look to try to preserve our wealth and preserve what we work so hard for. So, you know, depending on where you are in that life cycle, I would say a certain asset class may be better or not so good for you. And then within that asset class, you have to get very granular and specific as to what type of apartment building, for example, am I going to invest in? What type of area? And on that risk reward continuum, you know, you're going to make a different decision. So I really like multifamily. I'm a multifamily operator, and I'm still very actively looking for multifamily deals. I just am not chasing the same kind of deals that the REITs and the hedge funds are chasing, you know, in major MSAs, and a lot of us smaller operators as well. But I like self-storage. When we're heading toward recession, storage in general tends to do even better than multifamily. I'm actually investing today in a self-storage operation, and so I'm excited about that. I'm looking at some self-storage as well as multifamily. And I like independent living, because I think as our demographics change and our population ages, you know, basically you're still multifamily, but you're offering something to an aging demographic. And so those are kind of the main things that I focus on. But there's also a lot of demand for Airbnb right now. And so even within our multifamily complexes, we have several units that are Airbnb units. And it's something that you can, you know, have as an additional profit center that can do really well.
Oh, that's awesome. That's awesome. And I just want to correct one thing. You know, the name of my show is Generational Wealth Through Commercial Real Estate. So I'm kind of the same mindset as you. I want to be able to diversify my risk and, you know, chase the yield. You know, I'm all about yield chasing. I like multifamily. I like self-storage. I like retail, but I like what is going to give me cash flow. Because like you said, I'm in a life cycle right now where I'm about cash flow, you know, and as I, you know, age, I probably will change what I'm looking for. But as of right now, it's all about cash flow for me. Right.
And there are different asset classes that during different economies might provide different opportunities versus the other. So I think it's a fine balance, Willie, between, you know, really getting laser focused on your primary niche and the primary thing that you're going to do, especially if you're an operator. If you're a passive investor, you can invest in lots of different things without having to have a significant amount of knowledge in each of those spaces. But as an operator, you kind of hone in on what's your main thing and keep that the main thing, but then step back personally and say, if an opportunity comes that can piggyback on what I'm already doing and is not a huge leap in terms of my skills and knowledge that I have to grow in order to take on that asset, then you can open yourself up to opportunities that the market gives you without being totally green and taking too much risk and without being all over the place. So I see some operators that are like, multifamily is the only niche, it's the only thing we'll ever do. I don't think that's wise, but I also don't think it's wise to say, I'm going to dabble in hotels and self-storage and apartments all at one time. So there's that fine balance and that fine middle ground, and everybody's going to find it in a different place depending on your experience and your skills and your risk tolerance. Right.
And that's a very good point. And from what I've been learning, everybody that I've talked to, it's about building teams. And believe me, no matter what asset class you're going into, there's going to be somebody that's a beast at it, that's a pro at it. And that's going to be the one you want to partner with if you do decide to go on something that you don't understand. I'm sure you would agree on that, right?
Yes, absolutely.
Yeah. So let's talk about, you said something interesting about the Airbnb and on your multifamily. I haven't heard anybody talk about that. So let's dig into that a little bit.
Sure. So I live right outside of Hershey, Pennsylvania, and Hershey, Pennsylvania is where Hershey and Reese's chocolate are made. And we also have Hershey Park, which is a tourist attraction that people come from all over the country to visit. We have Chocolate World, and we've also got a really state-of-the-art hospital, a teaching hospital, a research hospital, and a children's cancer center and a children's hospital. And so we have a lot of strong growth and also a lot of visitors that come either for fun to visit Hershey, or they're coming because maybe their child is being treated for cancer or leukemia, and they don't have a place that they can stay and that they can afford for a long time. So we have a strong demand for vacation rentals. However, Hershey does not actually allow Airbnbs in residential neighborhoods. And so there's some back and forth. And as will happen throughout a lot of the country, there's this fine balance of regulators trying to allow, individual freedom of what you can do with your property, but yet keep the community safe from, things coming in like sex trafficking and drugs and these short-term rentals. And so a lot of municipalities are kind of toying with and trying to figure out how to find that balance. And for now, Hershey doesn't allow it. But because we are zoned commercial and we have apartment buildings that are either in Hershey or right on the border, like minutes from Hershey, but in a different municipality that allows Airbnb, we said we kind of have this competitive advantage where we have an apartment complex. It's zoned commercial, so we can offer Airbnb units. And since we know that other people don't have them, it's something that once we build it, they will come, so we said, let's take a couple of our units and let's just furnish them and list them out on Airbnb and the different websites and see how they do. And for a unit that might normally bring us $900 a month, if it was a year-long lease, we are seeing $3,000 to $4,000 per month on that unit. So we've done that, times two in one complex, and we're looking to maybe do the third or fourth. So we've only owned the property about a year, and we said, let's look at it. Summers are obviously, gangbusters. They just do a lot. And we said, let's just see how they go through the whole cycle and the whole season, and then decide, how profitable they are compared to your normal long-term rental. And they've done really, really well. So the newest complexes that we bought in December, we're currently working on converting 2 of those units also to Airbnb type units.
Yeah, that's awesome. So that really goes straight to the bottom line, because you didn't do much more other than furnish the unit.
Right, exactly. We made the finishes just slightly higher than what our area demands for a regular, annual lease. So for example, our area doesn't really command a premium rent for granite. There's just not enough people that are going to pay for it, or stainless steel appliances. So we might put in a nice countertop that's not granite, and we might put in black appliances. Where when we go to the Airbnb unit, we're going to put in the granite, we're going to put in a nice tile backsplash, we're going to put in the appliances. So we spend a little more money on the finishes, and then you just furnish them really nicely, and you do really, really well.
So do you think this would be a good strategy for anybody that's in a tourist location that has multifamily, or any hot city, I guess?
Absolutely. Yes. As long as your municipality allows it, I think it's a really strong profit center. I think the thing you have to just caution people about, Willie, is that I see it in the single family space, and I don't see it much in multifamily, but you have to be really careful not to say, we're going to be able to bank on this $3,000 to $4,000 a month forever for these units, because we don't know what's going to happen with the regulations. You know, the hotel industry is very quickly trying to compete with Airbnb. So like, you know, Hilton has, I think it is Hilton at Home now. So they, have these more Airbnb type of units where you've got full kitchens and dining rooms and all these things to try to compete. But while the market's giving it to us, let's take advantage of it. As long as the property makes sense, if you were to convert it to a long-term rental with normal market rates, I think you're okay. Where people get in trouble is where they buy a single family house in Hershey and think I'm going to make $5,000 or $10,000 a month on it. And really they can only make $1,100, and then the city shuts them down. So, they're going to be hurting if they overpaid for that property, thinking that these short-term rentals were going to last for a long time. But if you buy and say, I'm not overpaying for the property, I'm going to assume long-term rent, and then everything else above that from Airbnb operations is gravy.
Yeah. Gotcha. All right. So, you say you're mainly focused, your main focus is multifamily, but you're also looking at other asset classes. Just in general, how are you finding your deals that you're investing in?
A couple of different ways, Willie. Primarily, we are really concentrated central PA near our market. So when you know a market and you've been operating in that market for a while, you just build a reputation with brokers where off-market deals tend to come to you more easily than if you're chasing yield by going to different cities where you are not there, or you don't have partners that have strong history of having boots on the ground there in the industry. And so by staying primarily focused on central Pennsylvania, we truly get a lot of off-market deals. So we bought 200 units in the last year across a couple of smaller properties, and 2 of the 3 came off-market where the sellers approached us. And then 1 of them was pre-market, where just before the broker listed, they told us about it, and we were the only people they told about it, and we got the deal done. So, it's the ideal, what everybody hopes to have. And it sometimes takes years and years and years to get to a place where the brokers really are giving you pocket listings, or where, your title company, your attorneys, and your other realtors are saying, Anna's the one to call for, 75 to 150 unit apartment buildings, and sends them to us that way. So that's one way we're finding deals. We're also doing some targeted mailing and targeted contact strategies. And so, very similar to the single family space, we're trying to get in front of companies and people that own complexes to see if they might want to sell. And it's difficult to do that because, number one, it's difficult to find the actual, decision maker and to actually get your stuff in front of them. And just like I toss tons of mailers that come to me for people that want to buy my property, I've got to figure out a creative way to get in front of the right person. So we're doing some strategizing. We did a round of mailers of about 100, and we got 2 responses, which is pretty good for 100 mailers. We didn't buy any of them, but at least it showed us that we have the ability to get in front of these people. And then the third thing is just making broker contacts, broker relationships, and letting them know what we're looking for. And then partnering potentially with other people that find deals. So for example, Willie, if you found a deal in South Carolina and you didn't have the operations experience, but you were boots on the ground, you could analyze those numbers, you could get us in on that deal, then my company would come alongside you and say, hey, let's potentially partner on this thing, and we can work through it together.
Yeah. Gotcha. Now, you said you're doing direct mail, and there's not a lot of people that's doing direct mail in the multifamily space from what I've seen anyway. So if you could you elaborate a little bit more on, did you send was it actual letter? Was it a postcard? The kind of messaging that you put on it? Because I'm in the marketing as well. I did some wholesaling. I still do a little bit here. So it's all about sending letters and things like that. What are you doing to kind of help your message stand out?
So I will say this, Willie, that we are just starting this. So we're not experts at it by any means yet at this point. But my partner and I have both had some success in the single family space. He has another company that still flips, 75 properties a year or something along that line. And so we've got some experience doing some skip tracing and direct mail.
Right.
So basically we're finding the properties that we're interested in going after. We're not just blanketing every apartment complex. So it's like we're honing in on a particular set of zip codes and a particular size of property, and a particular age range of those properties, and trying to then hone in from the tax records on how long someone's owned a property. So if they've owned the multifamily property for a year or two, we're probably not going to mail them because they're probably not giving it up at this point.
Right.
So we're looking for ones that kind of fit our niche and the types of properties we want to go after. And then we're trying to find the actual members of the LLC, the general partners. And so we're finding, their names as we can. And if not, we still send it to the group and, hope that they open it. So inside the first mailer is basically a letter, not too unlike what you probably are sending out for wholesaling and direct marketing in the single family space. Just saying, we are operators of apartment buildings. We own X number of doors in your area. We're serious about buying our next asset. You've done a great job with your property, and we'd be interested in talking to you if you are interested in potentially creating a win-win sale for us both. We are not bringing an agent, so you don't have to pay an agent commission. Let us know if you're interested in another discussion. So like I said, out of the first 100, I think we got 2 responses, or maybe 2 or 3, but 2 that were serious. They just weren't quite what we were looking for. And so then the second mailer, we're looking to step it up. So we have a glossier piece. We have a bio of both my primary partner and I that talks about what we've done in multifamily, what type of assets we run, a little bit about our success, so that they can see that we are not a Joe Blow off the street trying to get our first deal, but that we really know what we're doing and that we really are able to take down a property. Because the other thing is apartment investors, where single family owners might be skeptical about, all these we buy houses people. Apartment investors don't want to waste their time. They don't want to be lowballed. And they want to know that if they're getting somebody in their units, they're serious, and that they have the money and the capital to be able to take down the deal and close successfully. It is, I think, the number one concern of sellers in this market is they don't want to get involved in something and then have it fall apart, especially when their tenants figure out that it's for sale. So by showing that we're serious players in the space and telling a little bit about us, it just is one more piece that hopefully will get them to say, even if I'm not thinking of selling now, let me hold these guys' information because maybe I'll contact them later. And that's what you always hope. And I've had that happen time and time again on the single family side. So we're hoping that it'll happen on the multifamily side. And then the last thing that we're doing, Willie, is we are making sure that when we're sending the packaging on our second round, that we're using, if we can find the name of a member, personal and confidential FedEx, because then we know the secretary's not opening it. Most likely she's actually putting it on the desk of the person who's the decision maker that's going to see it. So if we can get their eyes on it and get them to even look at it, we have a much better chance, because probably, I don't know statistically, but maybe 50, 60, 70% of those mailers just get tossed and don't even get in front of the right person. So we hope that as we continue to step up our packaging, that we'll get more and more notice so that they will read it and then really give us a serious consideration.
That's a very good point, saying I love marketing. I love looking at all the different ways to get in front of somebody and get their attention. And one thing that I've learned is, it's typically going to take about 7 to 8 touches before somebody actually understands what you're saying.
Yes.
You got to think about, they're constantly bombarded every day with, thousands of ads on TV, billboards, magazines. You're seeing ads constantly. So, the odds of yours getting, attention the first or second or third time around is going to be very slim. So you just got to keep going, and, consistency pays off for sure in that.
Yeah. And I think even, on the single family space, most people that are really successful, they'll tell you that the biggest reason that people fail with a marketing campaign is because they only mail it 2 or 3 times. It's like until you get in front of them that 4th, 5th, 6th, 7th time, your open rate goes up significantly, because it's like you're this little, nails on the chalkboard that continues to try to get their attention, and they finally go, okay, let me look at this thing.
Right.
So consistency is key. And so we're trying to do the same thing, especially being in a smaller market. We're not in a major MSA like Atlanta or like Houston or like Dallas. And so, we're not competing with as many people, but there are not as many properties available. So we've got to consistently stay in front of those properties that one day we would like to add to our portfolio. And we'll just keep consistently mailing them until they either tell us to go away or they call us and say, let's talk about selling my property to you.
Right. I think that's a winning strategy for sure. Now, if you could remember back, I know it's been some years now, but when you was first getting into the multifamily space, what was the biggest challenge for you? Because there's going to be a lot of people listening to the show that's just now trying to get into it. So what were you facing?
Oh my goodness, Willie, where do I start? When I talk about multifamily, I'll talk about the small scale stuff and then the big scale stuff. So when my husband and I started out, we really were starting from nothing. We had sold everything we had. We put in several $100,000 into starting his business. And we had nothing but my income to live on and hope that we did okay. And so we didn't have time and we didn't have money. I worked, we had 2 kids. I was helping him build his chiropractic business and then trying to learn how to be a landlord. So we really were, 70, 80 hours a week, didn't have any money, and we were having to make time, exhausted, tired, and didn't really have any education on what we needed to do. So thankfully, I kind of had a financial mind and I always thought like an investor. So I was able to kind of think through and create a business plan and say, okay, if we could do XXX, then we can have X number of dollars and, X number of years and we'll do fine. But we didn't have mentors. We didn't have coaches. We didn't have many real estate books. I read Multifamily Millions by Dave Lindahl and the complete guide to buying and selling apartment buildings. And those were like my 2 guides to how do I do this? And at that time, we were very much self-focused on we have to figure out how to find properties off market, or we have to figure out how to save up money or, create lines of credit or credit cards to buy on our own. And so when we started out, we were buying 4-unit apartment buildings and we were buying them distressed, fixing them up on our own, raising the values, raising the rents, and then taking the cash out and then putting that as the equity or down payment on the next one. So it was like the Burr method, but for small multi-unit properties. And it was a lot of grind and time and lessons learned without a whole lot of money. So it was very, very tough. And unfortunately, I had gone to a seminar where I listened to someone that was put on by a well-known REI organization. And this woman was trying to teach us how to buy apartment buildings and promised that she could help us get into apartment buildings with no cash out of pocket. And we would be, owners within a year and we would become retired within a couple of years. And I hired her as a coach. And long story short, it turned out that she was a fraud. She had defrauded hundreds of people at the tune of $10,000 to $20,000 a pop. And so it really jaded me from syndication and from working with other people because I didn't know who to trust. And so unfortunately, we did it alone, Willie, for the first 10 years. And eventually, it bought us financial freedom. Buying the small properties that you own 100% of can very quickly grow your wealth. And so we went from negative $700,000 in debt to several $1 million net worth in about a 5-year period of really consistent effort. Now, we had worked on that from 2007, but then we had a crash in 08 and 09. Money dried up. We weren't able to find financing to grow. And so it seemed to be very slow for a few years. And then 5 years ago, the bank started to kind of relax. I got better at owner financing and we started scaling again on just 4-unit apartment buildings, but they were enough to get me started and to grow our wealth and to get me retired. So for people that don't have a lot of time and don't have a lot of money, I like buying your own properties and focusing on that while you're on the track of trying to network with other people and utilize other partners and other people's time and other people's money to scale on the larger multifamily space. The reality is it's tough to do it alone. It's harder and it will take you longer in some cases, but you make bigger chunks of your own cash from what you buy individually. in the larger multifamily space, because of where we are in the market, and this happened before the last crash, when you're at the height of the market, everybody wants to be a real estate investor.
Yeah.
Every property is overpriced. The money kind of comes, but it's hard to find deals. And so if you're just waiting to find that perfect partnership or find a way to get in on a certain deal, you might be waiting for a long time to find the right deals and to find the right partners and get a teeny tiny percent of that ownership. And while it will help you in your knowledge and your growth, it's going to take longer than I think most people think to become independently wealthy through, partnering or syndicating on big multifamily deals, where you've lost some opportunity by not trying to grow your own at the same time. So I try to tell people, if you're just getting started, go down 2 tracks, both multifamily. So let's say you want to hone in on a niche and it's multifamily.
Right.
Go after the small multi-units that you can take down on your own and learn and grow by buying those units. Because buying the big multifamily units, it's exactly the same process, from the financing to the finding to the operating to the managing. It's the same. And so you learn more as an operator of a small multi-unit property than you do as one piece of a team that's doing one piece of that job in the big multifamily. And you can become a much better, larger multifamily operator because of that experience that you have on the small scale. So I like that I did it the hard way and the slow way, because it gave me the experience and the net worth and liquidity to be able to qualify for much bigger loans and to be a much stronger operator and asset manager of the big properties, because I'm just managing more doors in one location, but using the same experience and expertise that I grew over time on my own portfolio.
Gotcha. No, that's the best way to do it. I mean, if you can get in and learn, like you said, with the smaller stuff, duplexes, triplexes, quads, that's a great way to go, especially if you can house hack, because now you can use FHA financing, only got to put down 3.5%. That's a great way, really great way to get into it. Yeah.
And I think the other thing, just that maybe goes without saying, but I think a lot of people don't really think much about it. You see a lot of, 10X, rah, you got to go big, or you got to go home, or you don't play in the small stuff. But the reality is, these big multifamily buildings, most of the operators that you're seeing out there, they're going in with the plan to buy the unit, value add, sell it in 2, 3, 5 years, return their investors' money, and then start it all over again. And so you can make some good chunks of cash up front on acquisition fees and over time through your cash flow, and really on the back end when you sell. But it's still something that's transactional that you have to repeat over and over and over again. And so if you're investing in syndications with other teams, you can make some good money, but you can't bank on that income for the long term. It's like, okay, this is the income I'm going to make from this deal that's going to do this for us over the next 3 to 5 years. But then what are you going to do after that? So when you're buying your own for your own portfolio, they're properties that you can bank on and you control for 20, 30 years that help you build up that retirement nest egg, so that you truly build your own wealth that has both the income, the growth, and the asset preservation over time. So I think you should always, even if you start out big as a team in syndication, take the chunks of cash that you're making and buy your own property with that chunks of cash, because that's what's going to grow your wealth for the long term and secure it and stabilize it. Right.
Very good point. Okay, so what markets are you looking at right now? Why are you looking at them, as far as what do you like about the markets? And then I guess the deal size you're looking for in those markets.
Sure. So personally, and a lot of this has just to do with my family and where I'm located and what works for a busy family who, has active kids every night and weekend in sports. I don't have the bandwidth to travel a lot all over the country. So even though there's markets that I love in other parts of the country, I have to ask myself realistically, can I go there and handle those properties on a long term? And the answer is probably not as well as I could the properties that are in my backyard or in markets that I really know. So primarily I'm focused on central Pennsylvania because it's my backyard. I have experience and a reputation here that I can get some pretty good deals and off-market deals, and that's central Pennsylvania.
Mm-hmm.
In terms of on paper, they don't look super sexy because I'm not in Philadelphia, I'm not in Pittsburgh, so I'm not in a major MSA, but I'm in areas with really strong schools, really diverse employer base, and a strong economy that did really well during the last recession. And so I think there's something to be said about investing where you are in an area that you know and where people know you.
Yeah.
Second, I'm really actively looking, and I have been for a year, Willie, but I haven't found anything yet, at properties in Houston, Texas, and San Antonio, Texas. So not only am I from there, and my family are in both of those cities, and I know the areas really, really well, but I believe in the story of those areas, and I believe in the economic growth that's coming into those areas. Dallas is strong, but there's tons of competition, and I just don't know Dallas as well as I do Houston and San Antonio. So if I find the right deal that pencils on paper, you can bet that I'd go after something in Houston or San Antonio in the right submarket of those MSAs, again, with strong schools, strong employers, and where there's not oversupply. So one of the difficulties of where we are in the market cycle right now is most people believe we are in hyper supply in most areas of the country. So when you're going after these major MSAs, you have to look at the fact that there's hyper supply, and the supply and demand dynamics may not be ideal for purchasing there, in addition to the super high prices. So I like those areas, but I haven't been able to get a deal done there as an active general partner. I've invested passively in multiple deals in Texas that I'm really excited about. I'm just not the one operating those.
Yeah.
And then I have 2 apartment complexes in Atlanta, in different submarkets of Atlanta. And I love the Atlanta story. I mean, the growth, both population and the employers that are coming into Atlanta are really strong, one of the strongest in the nation. So Atlanta is an area where I asset manage 2 complexes, 100 unit and 150 unit in 2 different suburbs there. And we're looking for more deals there. So really like Atlanta. And then, I've got some partners and some good friends that are in North Carolina and South Carolina. And I like those markets as well. I just don't have I don't have the boots on the ground there for our own operation, but we have people that are actively looking for deals that have asked us to, potentially co-sponsor and help them operate those deals in those markets.
Right. That's awesome. I'm in North Carolina, so I'm a little bit biased towards North Carolina. But we got some great stuff going on in here. Raleigh, Charlotte, even Greensboro. A lot of people are sleeping on Greensboro area, but there's some good things going on there as well.
It's a very strong market. I think it was the 4th largest in maybe population growth or employer growth in the last year, but people don't really know a lot about it.
Yeah, absolutely. So when you're looking at a deal, obviously you got a lot of syndicators that probably come to you about opportunities. What are the red flags you look for in the underwriting perspective of it?
So personally, I am pretty conservative, and a lot of that, Willie, is because I have lived through the last recession. I have been unprepared and, like deer in the headlight, caught by the last recession and had no idea it was coming and made a lot of poor decisions because I wasn't prepared. So I've seen that, and that's given me a little more sense of less risk tolerance right now where I am in my life. And so I don't like deals that I feel like are risky or that depend on the status quo, depend on things are just going to continue to get better. We're always going to be able to get, strong rent bumps. We're always going to have decent cap rates while we own it, a plan to only own 2, 3, 5 years max, and people that think we'll be in and out before the recession hits. I don't think that's the case. Based on what I know of the economy and the economists that I watch and what the yield curve is doing and what the Fed's doing to try to hold off a recession with rates, I think we're heading for a recession. I don't have a crystal ball. I'm not an economist, but probably in the next year to 2 years at the most. And so I think that deals that really require heavy value adds and strong rent bumps that don't have some cap rate adjustments going in, I think are going to hurt. Bridge financing, I know that there's a lot about bridge debt that I don't really know what I don't know. And I've talked to some people who really like bridge debt heading into recession. And for certain markets, I think it's okay. But personally, I'm not comfortable with investing with bridge debt right now. Because if I'm buying an asset that doesn't fly for Fannie and Freddie qualifications and underwriting, which is pretty stringent, then that means that I'm basically having to go bridge financing because there's something about the deal that makes it not stable where it is in lender perspective. And so while there could be lots of upside and there could be reasons that it's not stable, and you can go around and turn that, I think heading into a recession, there's just more risk of not being able to refinance out of those bridge loans, because in the last recession, banks really tightened up. And so, I was getting loans pretty easily, and all of a sudden nobody would lend to me. And that happened in the real estate market quite a bit. And so I want a strong area that has strong schools, because when people have a recession, they're going to try to do anything they can to keep their kids in those good school districts. And they might not be able to pay significantly higher rent bumps, but they'll still pay more to stay there. And they're not going to downsize into less nice areas. So I like strong schools, strong areas that have a lot of employers, so that if people are laid off, you still have enough people in the area to rent and to keep those properties occupied, and with long-term fixed financing. So if it's a deal that they're locking in, 10 years with Freddie or Fannie at a low fixed rate, and maybe has some years of interest-only period to help them with their value add. And if they project flat or maybe only 2% rent bumps for those units that aren't being updated, if they project a cap rate that's higher on the exit than what there is today, I'm going to feel better about those deals. But if they've got, bridge lending, they're not in an area with strong schools because they're chasing yield where they shouldn't, where there's not a lot of strong employer diversity, where their cap rates are the same on exit as they are going in, I'm going to be more nervous about those deals, and most likely I'm not going to invest in those deals. Yeah.
That's some very good points there. Very good points, and I'm pretty sure a lot of people are taking some good notes for sure. Okay, last question on this segment here. What is the biggest rookie mistake you see people making?
Oh, over leveraging. Probably that one.
Yeah.
If I only have one, that's it.
Yeah. So they're taking on too much debt to try to get a deal done.
Yes.
Gotcha.
Or the wrong kind of debt, and not having enough reserves. So, it's a fine balance. I am a strong believer in leverage for multifamily investing. When your tenants are paying your debt and you still have cash flow at the end, and it's a strong cash flow, then I say, leverage, but you've got to make sure you have enough reserves. So along with the over leveraging, a lot of times people don't have enough operational reserves for big things that can go wrong. So when those big things go wrong that are unforeseen, you struggle to make your debt service. It's one of the worst positions you can be in as an operator and investor, and why a lot of people lost their shirt in the last recession.
Yeah. Gotcha. Okay, so let's go ahead and segue into the next segment of the show. It's called the Deal Deep Dive. And we're just going to talk about a deal you've done recently that you want to talk about.
Sure. So any particular aspect that you'd like to hear more about?
Yeah. Let's talk about, let's look at multifamily, since that's what most people are familiar with. How many units it was, what was the value add play you've seen on it, and the kind of debt that you put on it.
Sure. So the most recent deal we did 96 units right in the Hershey, Pennsylvania area. And it was a pre-market deal. And it's interesting, Willie, because we had already mailed to this seller a couple of times. We had called the seller a couple of times because it was word of mouth from the seller that we bought the previous property from, that this guy was wanting to retire and might want to sell. So we had tried to get these properties and get a hold of this guy, and he didn't return our phone calls at all. And we were walking another complex that we really weren't that interested in, but we really wanted to meet the broker that was listing it, because we knew he was really well connected and did a lot of really solid deals in our area. So we went to see this property and we're like, I don't know if we're that interested in it, but we wanted to meet him and have a relationship. And so when he asked what we thought about the property, I said, it's okay, but what I'm really looking for is more like our Hershey properties. He said, we're about to list a Hershey portfolio. We haven't finished putting all the numbers together, but he's, looking ready to sell. And, he wants $10 million for the 96 units. And I was like, is this the seller? And he said, yes. So we're like, whatever you got to do, get us in it. We want to see it right away. So thankfully we got in it, and through a long process, we ended up getting it under contract. So we were very grateful to take down this particular complex because it is one that we wanted and we're targeting. So it was off market. We bought the 96 units for $10 million. So it was about $104,000 a door. And what was the beauty about these units really was the location. And so again, being in the Hershey area, we are very, very close to the Med Center and Hershey factory and Reese's factory and most of the employers here. But this owner, who was in his 80s, had kept rents very, very low for his tenants because he didn't have much debt on the properties. And he had babied these properties, very mom and pop, but he loved these properties. He was on site every day that he wasn't in Florida. And so, they were in really good condition. They were just dated. And that's what you want. When you can find a complex who it's been very well taken care of. There's not deferred maintenance. Maybe there's some things that can be sexied up and, improved to make them look newer and nicer. But in terms of the CapEx needed, there wasn't a significant amount. And what that meant for us, Willie, is that right away it cash flowed. So even if we did nothing to these units, we still were cash flowing without doing much. But with maybe 80% of the population on month-to-month leases and with rents $200, $250 below what the market was, we knew very easily we could go in, raise rents on all the existing tenants $75. If we raise it $75, they're not going to be able to go anywhere else as nice and not pay $100 or $150 more or $250 more. So we could do a modest rent bump that was fair to the residents, allow them to lock in for another year without us having to put CapEx in it if we didn't want to. And if they move, it's no big deal. We put the CapEx in the unit, we put in vinyl plank flooring, and we paint the doors, and we paint the walls a two-tone instead of the old antique white that everybody has. And just for those minor changes and maybe updated lighting or an updated vanity mirror, a few $1,000s and we can get $250 rent bumps. So those kind of properties are really what you want all day long because they're a cash flowing asset in a strong, stable market. The rents can go up without a ton of work and a ton of risk. And we got long-term agency debt. So we got 10-year financing, 5 years of interest only through Freddie Mac. And that interest only period is allowing us to, take some time to redo these units and to put some CapEx in and to meet our business plan. Now,
since you're buying in your backyard, are you buying these for the long term or are you going to sell them after you add the value?
So the 200 units that I bought in the last year, I bought with two partners. So they are joint ventures. They're not syndicated. And our plan is to hold these 200 units for the long term for 10 years. And so, as long as we have the debt on the property, we'll hold them. There's some potential that you could refi out, with Freddie debt, the prepayment penalties can be steep. Depends on what the interest rates are doing, whether they're down or up from the time that you've taken those loans. But we really have these particular units as our long-term bucket. So they're generating not only the income, but they have some appreciation, and it's a solid place to preserve capital. If we hit a recession, we'll be able to weather the recession and come out on the other side to where 10 years from now, we'll probably be back in a strong growth phase. So these are our long-term bucket that also has the benefits of income and appreciation.
Yeah. Well, thank you for sharing that. That sounds like you guys got a pretty awesome deal there.
Yeah.
All right. So last segment of the show is lightning round. You ready?
Sure, I'm ready.
All right. What's the best advice you ever been given?
Be true to yourself.
Be true to yourself. Like it. All right. What is the best book you've read this year?
The best book I've read this year is Raising Private Money by Matt Fairclough.
Yeah, I read that book too. That's a pretty good book.
Very good.
What are some rituals you've created that's making you a better investor or person in general?
Really every morning since I've retired and for years before then, but really more time since I've retired, every morning after I get my kids off to school, I just have time where I have my coffee, I pray, and I'm in the Bible. And I try to read Proverbs. That just gives us a lot of wisdom on life and wisdom on the wise handling of money. So a lot of people don't really realize that the Bible, not only is it a book about God, but it also talks more about money than almost anything. And so I really try to remind myself in my pursuit of wealth, what is that really for? What's the purpose of pursuing wealth? How do I do it the right way with the right balance to where I'm not consumed by the love of money, but I'm using money as a tool to help me to live my life on purpose and to be a blessing to other people.
Right.
And that's, I think, the most important ritual for me is just that quiet time and time of reflection and making sure that I'm living my life on purpose.
That's awesome. That's awesome. All right. What is one thing you're doing right now to help you improve your business?
I am learning, Willie, to say no to many good things. And it's a hard place to be. You know, I have been a go-getter and someone who's been very driven for my entire life. And I, other than about a 5-year time span, in the last 20 years, I've worked 70, 80 hours a week, plus raising kids and, you know, my relationship with my spouse. And so I've only known go, 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 go. And I haven't really allowed myself time to just say, I want to just be. If I can just be and I can totally control my day, what do I want to do and what's going to give me joy and purpose? And so I'm taking time to kind of step back and say, I'm doing lots of really good things. I love, you know, I was coaching and I'm still coaching right now, women investors and helping them get started. And I'm running a meetup group and I'm speaking on events and traveling and then running my business. But I realized very quickly as my husband and my kids were saying, Mommy, you're retired and you're still working late. I thought you weren't going to work late anymore. You know, it's like, okay, Anna, you've got to be able to pull back and say, what's most important in life? How many hours am I really willing to dedicate to my business? And in those hours, getting really laser focused and strategic about the use of my time, which means I've got to say, you know, I'm willing to work every day from 8 until 3 because my kids are home at 3. So if I want to work just from 8 to 3, how many hours a day do I really have? So I'm learning to time block the things that are going to move the needle the furthest in my passions and my purposes, and then financially. And so I'm learning to time block those times and say, how much time do I have left? Oh my goodness, I only have an hour a day left. Well, that means something's got to give. I've got to learn to say no. And so for me, I just decided, where you asked me a few months ago, like coaching was a big thing on my plate because I'm passionate about it and I love helping other people. But I realize it takes so many hours a week that I really don't have to give back to other people if I don't have that time first to give back to my family and to pour into myself and things that bring me joy and contentment and my health. Right. So I'm learning to slow down and to say no and to just be okay with making progress without 10x killing it all day, every day.
Yeah. That's very good. Very good. Okay. Now, last question for you. If you can give your younger self one tip in regards to investing, what would that be?
Know your market and know the economy. Study the market, study the economy, and make sure that you don't invest in anything that you don't know. Right.
That's sage advice. Sage advice there. Okay, so Anna, give us my listeners, I guess, the best way to get in touch with you, because there are going to be a lot of people that's listening to this and they're going to say, how can I find her? You know?
Sure. So on my Facebook group, I have a group called Creating Real Estate Wealth That Lasts with Anna, ReiMom. And that's where you can connect with me and with others and just really learn some tips and tricks about doing this thing for the long game and doing it well. And for people that are interested in passive investing in syndications, zenithcapitalinvestments.com is our business website.
Gotcha. Well, thank you so much for coming on the show today. You added a lot of value to my listeners, and I'm looking forward to connecting with you in the future.
Thank you so much, Willie. It's been my pleasure.
Absolutely.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.